David Reyes, your retirement architect, back here with you. Thanks for listening. We're getting into the what I call the 7 rules for retirement security. And so pay attention. This is important. This is kind of my life's work in 7 rules. Trying to make things simple for you in a very complicated financial world. So 7 rules for retirement security. Rule number 1, we talked about in the last segment, avoid losses, avoid large losses. You want to keep your losses just over time in a 5 to 10% range. Most of you have way too much risk in your portfolios. If you experienced the last quarter of 2018, if you lost 10% or more, you're too aggressive. And so, unfortunately, most of you are in what I call the 30% range, where if we have another bear market like 08, you'd probably lose about 30% of your assets, or about $300,000 per million. So we want to mitigate losses. So there's ways to do that we'll talk about later. We want to minimize fees, because fees are a cost. They're an expense, just like taxes, anything else that we have to pay for. And so they reduce the rate of return. They draw down the rate of return. So fees are a big deal. Part of the review and part of what we do for clients, our complimentary financial reviews, is that we do a whole fee analysis. And we basically take apart your investments, literally. And we can break out the fees for you that you don't see. 80% of your fees is the iceberg theory, right? You only see the tip of the iceberg. And 80% of your fees are under the water that you cannot see. So that's very enlightening for people to understand that. And so I love doing it because it enlightens me. I love doing them every time because it's just interesting to see the type of fees that are being paid. And there was an article that was written last year in Financial Advisor magazine, and the title was, Who's Managing Your Money or Taking Your Money? It said Ameriprise, UBS, and Morgan Stanley, Wells Fargo, and Merrill Lynch called out as the most expensive advice firms. It says stated advisory fees can be as high as 3.5%. 3.5%. That's high. Remember, I told you earlier, 92% of you don't know what you're paying in fees. In fact, there's another poll I read, the Harris poll, it says 61%, and that's not correct. Over 90% of you have no idea what you're paying in fees. So it wouldn't be worth the time for us to spend together just to teach you about your fees. And because I can save you a lot of money just doing that. But let me give you an example. I don't want to spend too much time on this. I don't want to get in the weeds too much, but I do want to give you an example of taking apart some of the cost of a mutual fund. So you have what's called a expense ratio. That's what you can see. If you go to Yahoo Finance and you own a Vanguard Index 500 fund, you're going to have an expense ratio. And that's usually, let's say, the average cost, according to the research I have right here. This is by Forbes. The average cost of a mutual fund is 0.9%, less than 1%. Saying, Dave, well, that's not horrible. That's not 3.5 like you said, or 4. Well, you have transaction costs internally. There's trading costs within the mutual fund. They're buying and selling stocks. And believe it or not, that average is about 1.44%. So more than the expense ratio to run the fund. Then there's a thing called cash drag. Saying, Dave, what the heck's cash drag? Well, it's actually an institutional term, and what it means is what it says. If you have a lot of cash inside of a portfolio, a lot or a little, it reduces the rate of return, right? If you're investing your money and not all of it's invested, well, you're not getting 100% of the investment returns. You're getting a percentage of that, or less percentage. The average cash drag is 0.83%. Taxes, the average taxes on a mutual fund through distributions, things like that, capital gains, is around 1%. So according to Forbes, you add up all these fees, you're talking about 4.17%. That's insanity. And I can tell you on average, doing this for a long time, the average person listening to me, you're paying around 3.5% in fees. That's typically, off the top of my head, what I see. So let me give you an example. So let's just say between 1999 and 2013, you invested $100,000. Okay? I want this to mean something to you. And you paid no fees. So you're invested in the S&P 500 index. So between 1999 and 2013, you would have made $50,000. You'd have $150,352 to be exact. Let's say you paid 1% fee. Well, over that time frame, you would have $129,000 or $21,000 less. So it cost you 21% over that time period in fees. What if your fees were 2%? Well, over that time frame from 99 to 2013, you paid $40,000 in fees, or 39% of your portfolio. Let's get into the average fees that you pay, 3%. So over the time frame from 1999, a 14-year period, to 2013, you paid a total fee. Your fees were $55,000 or 55% of the portfolio value. So instead of having a portfolio with zero fees, which isn't realistic, but let's just say it was, you'd have $150,000 over the 14-year period from 99 to 2013, or the average person I sit across from pays at least 3% in fees. Your fees would cost you $55,000 over that time frame, or 55% of your portfolio. So if you could just cut your fees in half, which is typically what we do for clients, I mean, that's a lot of money. So if you want to talk to me, if you want to sit down and get together with me for a second opinion, talking a lot about fees today because they're super important. You want to learn how to mitigate loss in your portfolio. You want to mitigate your fees. We have a complimentary second opinion. We'll sit down with you. I'll sit down with you personally. We'll do a review of your risk in your portfolios. We will do a fee analysis. We'll give you a written retirement plan. Basically, everything you would need that you need to know to do your do a retirement plan. And we always say the term, we want to have the most amount of money with the least amount of risk without running out of money, because all those three things are important. So if you want to take the advantage of the opportunity I'm giving you to sit down with me for a second opinion, give me a call, 1-800-611-1967. It's 1-800-611-1967. Or go to reyesplan.com. It's REYES plan.com. You know, I was reading this article. I read a lot of crazy, weird stuff, but usually in psychology, and they were talking about memory, your cognition as you get older. And then we're talking about this exercise where these put together, the exercises you get these stickers, and you put this trail together, kind of like you follow the dotted lines, and you have to put these stickers down. And they were saying in this study that the average 50-year-old has a 60-year-old brain. So I was going, wow, so just putting stickers on a path, and they were talking in this particular article about magnesium and salt, and it was this paper about that, but this study was talking about increasing these vitamins, minerals to your body, but it was a real study, and I was laughing because I'm 51. I'm going, shoot. I want to see how many stickers in a row I can put on a trail and how fast I am. I'm probably 70, but anyway, it was funny because, you know, I always think about planning and consider myself decently sharp, but I'm gonna have to take this test because I was surprised and shocked by the results. But so we all need help. We all need to we've done our whole lives, whether you're a teacher, a firefighter, we do police officers, who else? Just a Navy captain hired us. We have all walks of life, which is fun. I always say somebody has a story to tell. Everybody's interesting. So I have the best job ever. I get to listen to people's stories of their lives, and I get to help them with their financial lives. So if you want to take advantage again of our second opinion, I'll go through your investments. I'll go through your taxes. I haven't talked about that. We'll show you how to reduce your taxes as well. We'll look at your fees inside of your plan. We'll do a free retirement income plan for you. Just give me a call, 1-800-611-1967. That's 1-800-611-1967. Or go to reyesplan.com. That's REYES plan.com. So we're talking about the 7 rules for retirement security. I've talked about number 1, avoid large losses. So keep your portfolio losses between 5 to 10%. Number 2, we want to minimize fees. The average fees you're paying is between 3 to 4%. Inside of mutual funds, inside your 401k, that's just what it is. The Forbes study that came out a couple of years ago, so the average total cost for a client, an investor, is about 4.17%. So number 3 is we want to significantly reduce volatility, right? So if we want to stay in that 5 to 10% range for max losses, want to mitigate fees, we also want to reduce the volatility. So one of the strategies I'll talk about just briefly one thing is you need to know about our firm is we're a registered investment advisory firm. We're a fiduciary to you, which means we have to put your interest ahead of our own in the firm. That's very important. But on top of that, there's not a lot of firms that have expertise in really the asset class I think that you need to be an effective advisor. Quite honestly, if you walk into, I'm going to pick on Merrill Lynch, it doesn't matter, Ameriprise, most of those advisors, there could be great advisors, I'm sure they are, but they're basically experts in stocks and bonds. Well, there's more assets than stocks and bonds. In fact, on our website, we have a whole page that says Beyond Stocks and Bonds. There's real estate, there's annuities, there's other things that don't have any correlation to the stock market, right? So if you can have investments that have their own return stream or not correlated to the stock market, to stock or bonds, you can reduce the volatility of your portfolio. But one of the favorite strategies that I have is called a stop loss strategy. And I'm going to finish this segment with this. Hopefully I have time here. But it's called a stop loss strategy. It's really simple. Basically, the maximum loss in the portfolio at any one time is 10%. So let's just, and we use Vanguard funds to use this strategy. Okay, there's 11 sectors in the S&P. When we're invested, we own all 11 sectors. When we're not, we're either in bonds or in cash. So bottom line is you can participate in the market upside and minimize the losses by having this particular stop loss. And institutions use this all the time. So basically they're saying, okay, if the price of this security or this portfolio gets to this level, then we're going to sell or we're going to go to cash or make some new decisions. So the nice part about it is your portfolio grows. The stop loss will follow you in the sense that, so it's locking in profits as you go up. So I'll talk more about this, but I did want to talk about one of the ways to mitigate risk and mitigate volatility is annuities are a great way. We use annuities as well. But from a stock perspective, one of the things we like the best that we use quite a bit that's pretty simple is using our stop loss strategy that has a maximum loss of 10%. So if you want to reach out to me, you want me to do a complimentary second opinion for you, I'd be happy to, just to learn about you and seeing if I can help. We'll do a couple things for you, 3 things. Number 1, we'll do a risk assessment for you and make sure you're not taking on too much risk. 2, we'll do a fee analysis for you. Make sure you're not paying too much in fees, which you are taking on too much risk. You are paying too much fees, and I'll bet you $1 don't even know you yet. If you bring the $1 with you when I see you, that you are paying a lot more money in fees, and you have a lot more risk than you think you do. And 3rd, we'll do a written retirement income plan for you. So all that complimentary. And why would I do it? Well, if you go through that process with me, there's a high probability we'll work together. If not, then I'm happy to do it. So this is David Reyes, your retirement architect, and I'll see you soon. Thank you.